The inflation's here. So I'll say 2 years from 2020 and over the course of 2021, there was a big debate in economics and among analysts about inflation versus maybe disinflation. Still have inflation, but at a lower rate. And that debate kind of went on through most of 2021, but that's over. Inflation's here. There's no more debate about it. The new debate is, will it persist? Will it get worse, which it might, or will it be subdued in some way? Again, you can see the inflation coming. It's here. It's going to persist for a while. The big question will it kind of tail off quickly over the next few months, or will it kind of be the dominant theme for 2022? I definitely lean to the latter. However, going out, maybe 9 months to a year, I see that curve bending and getting into a more disinflationary mode, not for good reasons. Well, what does have to do with subdue the inflation, but at the cost of a very severe recession, not a mild recession, a very severe recession. So the question is, to me, the biggest question in economics is, will the Fed go down that path, do what they have to do the only thing they can do to subdue inflation at the cost of a very severe recession and something like a stock market crash? Or will they see that coming? They'll be the last to know. We'll all see it before they do, but they'll be the last to know. It's because they rely on flood models and they're kind of in their own economic forecasting bubble, and they're very defective ways of thinking about the economy, and they're very much a creature of inertia. There are a whole lot of reasons why the Fed is not nimble. It's kind of quite the opposite. But they'll see it eventually, probably when it's too late. And will they balk at that point and stop rate hikes and maybe even reduce rates? That could save us from the recession, but that will just amplify the inflation. So we've seen this movie before. This is a replay, and I think it's on, like you hit the remote control for double or triple speed. It's going to happen faster, but this is a replay of everything that happened from 2013 to 2019 and ended 2020. Okay, so 2013 May, Bernanke says we're going to taper asset purchases. That's money printing, quantitative easing, whatever you want to call it. The market, tanks, bonds go down. Everyone's like, oh, it's over. And then Bernanke balked. But finally, in November 2013, they said, okay, the taper begins. They were still printing money, but at a slower rate, and that matters. That went on until late 2014. The taper was over. They stopped buying new assets. They said, okay, here come the interest rate hikes. Except they didn't come for another year. It wasn't until December 2015 that then Janet Yellen finally raised rates. And then another year for the second rate increase. So it was December 2016. So it was really, really slow. It took 2.5 years, but they got to 2 rate hikes. So then here comes Jay Powell, and then like clockwork, boom, 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 25 basis point hikes every meeting. And all the Fed was trying to do was to get back to normal. They were trying to get interest rates to maybe 2.25, 2.5, get the balance sheet down to, something like 2.5 trillion. They never specified it, but that would have been a reasonable level. So, okay, now interest rates are kind of normal, 2.5, balance sheet's down around 2.5 trillion. We're back to normal. We finally got through the global financial crisis of 2008. We kind of undid all that stuff. Well, what happened? From October 1st, 2018 to December 24th, 2018, the stock market dropped 20%, the Christmas Eve massacre. Stock market went down 3% in one day. But the Fed was tightening into the weakness, as they always do. And the last interest rate hike, it was December 16th or 17th, within a day or two, but mid-December 2018, they were still hiking and raising rates. And that was the last straw. And then the market just tanked. And then finally, Jay Powell got that message. First week of January 2019, he says, that's it. We're going to be patient. Use the word patient. It's one of these code words. You have to get the code book out and see what it means. But patient means we won't raise rates again without giving you advance warning so you can get out of your trades or whatever. And then he went further, said, looks like we got to cut rates. And they did. And then by early 2020, here comes the pandemic. And then they took rates all the way back to zero. And then they started QE, 6, 7, call it what you want. They took the balance sheet to $7.5 trillion after getting it down to $3.5 trillion. So look at that whole sequence from 2013 to early 2020, including the pandemic. What happened? They tapered the asset purchases. They raised rates. They sank the stock market. Then they said, okay, no more rate hikes. Then they cut rates, and then they started QE. And by April 2020, where were we? Zero rates, back down to zero, and the balance sheet was $7.5 trillion after getting down to about $3.5 trillion. So that was a big circle. They ended up back where they started from. But the point being, they failed to normalize. They failed to get rates where they wanted. They failed to get the balance sheet where they wanted. They did sink the stock market. Okay, Now, 2 years forward, here we are again. What are we doing? They just raised rates. They're going to raise them again. The easiest forecast I've ever made. By the way, I don't have a crystal ball. The Fed told us this. I mean, that's the thing about the Fed. They may be wrong, but they're transparently wrong. So they tell you what mistakes they're going to make in advance. So that's the Fed forecasting is actually fairly straightforward because you just have to believe them. So a reduction in the balance sheet, $100 billion a month, reduction in asset purchases. So that's QT, quantitative tightening. In other words, they're running the same playbook they tried to run or they started to run in 2013, 2014. But here's my question. They failed the last time. Why do they think they're going to be any more successful this time? Why do they think they can get out of this? And the answer is they cannot without a recession. And this is what Larry Summers has been saying. I think he's right. And, everyone's jumping on board Alan Blinder and all these other big brains from Princeton. But the point being, they can normalize rates in the balance sheet and they can stop inflation, but not without causing recession and not without causing a stock market crash. So the big question for the next year is, will the Fed do that? And they may. Paul Volcker did it. Or will they balk again, at which point you might rescue the market, but the inflation is just going to go wild. But the thing is about framing it that way, you've got two paths. And we'll get signals along the way. We won't be the last to know. The Fed will, but we won't. You'll be able to see this coming. I would increase my allocation to cash. The most powerful investment tool we have is diversification. Now that sounds like an obvious statement. Oh yeah, everybody knows that. They teach you in the first week of risk management. Diversification is the way to go. Well, it is the way to go. The problem is people don't understand what diversification means. So I run into people all the time. They say, well, I'm completely diversified. I own 50 different stocks in 10 different sectors, semiconductors, consumer non-durables, minerals, et cetera. And I say, you're not diversified. You may own 50 stocks in 10 sectors, but you have one asset class, stocks, which are subject to conditional correlation. In calm markets, they're idiosyncratic, but in panics, they all go down together, or in bubbles, they all go up together. So you're not diversified. So what is diversification? Diversification is having slices of asset classes that are minimally correlated. It's probably not zero, but as close to zero as you can get. So what would that be? You'd have a slice of gold, but I recommend 10%. I have some strong views on gold, and I've written a lot about it, but people are surprised to hear me say 10%. Like, oh, Jim, why isn't it 50% or 100% if you believe all this? Well, I do believe it. I wouldn't say it if I didn't, but you don't want to be 100% in anything. You don't want to be 50% in anything. 10% is fine. If I'm wrong, you won't get hurt. And if I'm right, you're going to make so much money that it'll actually kind of be the insurance on the rest of your portfolio. But that leaves 90%. So I would have a large slug in cash, maybe 30%. And cash is the opposite of leverage. So leverage increases the volatility of the rest of the portfolio. You'll get much bigger returns, but you'll have much bigger losses. If you have a slice of cash and you've got a volatile asset over here, which are stocks, and another volatile asset over here, gold's fairly volatile. If you got that volatility and you have cash, it will reduce the overall volatility so you can sleep better at night. Cash is a great asset in deflation. We were talking about inflation, which is here, and you got to deal with that. But don't rule out deflation. If we go into a recession because the Fed over tightens, or the Fed can't drill for oil, raising interest rates doesn't get you more oil or natural gas. So the Fed can't do anything about it except kill the economy. So that depresses all those other areas. So there is this recursive function. So don't rule out deflation down the road. Not right away, but maybe next year. But here's the biggest value of cash. It gives you optionality. People don't understand this. What if I said to you, hey, I'll sell you a call option, an at the market call option on every asset class in the world? You go, gee, that sounds kind of valuable. Well, that's what cash is. When things are crashing, you're the one who can go shopping. And nobody's better at this than Warren Buffett. He's got his cash level at Berkshire Hathaway is at an all-time high. So there's a place for that. I'm not a crypto basher. When I was a teenager, there was a popular song called Shout, Shout, Knock Yourself Out. If you want some crypto, knock yourself out. Go get it. I'm not bashing it. I'm not against. I don't own any. I don't plan to. I don't recommend it, but I'm not lying down in front of a truck trying to stop the crypto move. It's here. I've actually studied it more than all but a few people. So I think I have a very good handle on it technologically, mathematically. Well, let me put it this way. I'll say crypto is not money, but what crypto is doing is erasing the definition of money. So maybe the dollar is not money either, and that's really the point. It's not the case that Bitcoin is going to replace dollar as a global reserve currency. That's not going to happen. My thesis would be we don't know what money is anymore, but we don't know that we don't know. It's like we don't know who discovered water, but we're sure it was not a fish because the fish is in the water. You got to take the fish out of the water and it's like, hey, where's the water? But when you're immersed in something, you actually don't know what it is. And we're immersed in an electronic orb, if you will, and it's erased a lot of concepts, but we don't know it. And so I think we're seeing the end of money.